Well, recent economic reports on the rise of the Federal Reserve interest rate, specifically higher mortgage rates, have worried some consumers. The market for home mortgage rates has been up recently over historic lows. Still, 30-year fixed rates are low, holding between 4.125% on better days and 4.25% on tougher days. An eighth of a percentage point rise might not sound like much, but it does affect a borrower's cost over the life of the loan. But by how much? Joining us is Jeff Berger, president of Groundwork Mortgage, to break it all down. Now, what does this uptick mean for the average consumer?
Well, what it means for the average consumer is that the cost of borrowing has increased. There's no question. It's math. So it means that the interest associated with the loan has risen by about an eighth of a point. If we look at a typical $200,000 loan as an example, that difference between a 4.125 rate and a 4.25 rate equates to approximately $15 per month higher in principal of interest. So if we take that over the course of a year, we're looking at about a $180 increase. And over the course of a 30-year loan, that can equate to a $5,400 increase in the principal and interest payment associated with that change in rate.
And there's a lot that you could do with that $5,400
yes.
if you were able to use that elsewhere. So should borrowers be worried now that we're hearing about this uptick?
Borrowers shouldn't be worried. Since we're talking, for example, about a 30-year loan, I think it's important to keep this conversation in a historic perspective. At the 4.25 rate today, we only need to look back as far as 2014 to see rates that were equivalent, about 4.25. If we go back a little closer in history, according to a Federal Reserve chart, we can see that rates were at 4.5 as recently as 2013. What does it mean? What it means is they shouldn't be worried because rates are still at historic lows. There's still a tremendous amount of value in the market, albeit at about an eighth or a quarter% higher. The point being, customers should be vigilant. They should be talking to their mortgage professionals, they should be monitoring the market, and they should be organized so that they're able to react quickly with a loan application and capitalize on a rate when there's true value that suits their needs.
So for those people looking for a first-time home, is this still a good time to buy one, to buy a house?
It's still an extraordinarily good time to buy. If we look at that Federal Reserve chart again, we can see that we don't have to cast our minds back too far to see rates that were in the fives. So for us to be in 4.25 territory, again, tells us still tremendous value. $1,500 or $15 per month. Yeah, it's a couple of trips to the coffee shop. $5,400 over the cost of the life of a 30-year loan. That's a different order of magnitude. But in the scheme of things, it's still tremendous value.
Speaking of that trip to the coffee shop, is there any way that you can budget for these fluctuations?
Excellent question, and the answer is yes. There's a couple of very important strategies. Number one, customers should shop carefully. It's very important to understand whether the rate that they're applying for is a rate that's locked or a rate that's floating. Is it a rate that's reserved for them for their transaction or still subject to changes in the market, number one. Number two, they should read and ask questions carefully about the time period of that lock. Is it locked for 30 days, 60 days, 90 days? And they can then correlate that to their transaction. Are they going to be closing in 30, 60, or 90 days?
I see.
So understanding the lock, key question to the equation. Once we know that and understand their transaction, there are some loan programs and products that are available that can help them hedge the market. For example, we can reserve a 120-day rate, which for someone that's building a new home that they intend to move in and that's going to be constructed over a 4-month period of time, it's a way for them to understand today what their payments will be 120 days from now. Now, there are costs associated with these decisions, but we can run the math and say, if that savings of an eighth of a point is going to cost you $1,000, but it's going to help you alleviate a $5,400 cost over the life of the loan, you might be $4,400 to the good. What's the lesson? The lesson is to be having open, honest, and constant communication with a loan professional to monitor the market for you, help you make wise decisions, and help you lock when the moment is right.
All right, Jeff Berger, president of Groundwork Financial. Thank you so much. We appreciate it.
Thank you.
Groundwork Mortgage. We definitely promised to break it down, and he did. Let's go ahead and send it over to Chandrea.
All right, thank you.